Real stories, expert insights, smarter decisions.
So didn't set out to become an investor, incidentally. I mean, I live in the eastern suburbs. A friend of mine introduced me to Scott. He's very good at educating.
What was it about what your friend told you about when it comes to investing where you're like, oh, actually, this makes sense?
It was more removing the pressure of having to pay your own mortgage, I guess, in a nutshell, and getting someone else to pay off your house. Removing some of the risks that being a homeowner comes with, some of the responsibilities.
Which is buying residential for capital growth and buy residential for cash flow. I say that quote unquote because most residential property isn't going to cash flow, right? But that doesn't mean you don't target residential properties in areas with maybe a higher yield, but isn't expected to have as much capital growth.
I'm a big advocate for obviously the business, and I look forward to helping other clients do the same as me.
Tune in and find out.
Well, g'day everyone, it's Liam Garman here, co-host of the Inside Residential Property Podcast. And today we're going to be unpacking an episode which you cannot miss out on. It is the fundamental building blocks of how you can build your residential property portfolio and where you scale on from there, including when is it the right time to move into commercial property, some exit strategies, and how you can build a passive income. It is a must listen for all of our listeners. But today I'm joined by my co-host, as always, James Thompson from Rethink Residential. Mate, good to chat again. It's been a while.
Thank you. Yeah, it's been a couple of weeks. I'm always glad to be back to dive into some property strategy and hopefully add some good insight into the world of investment.
So today we're going to be unpacking portfolio architecture, which is, I think it's a problem that I'm going to guess day to day when you're working with your clients, you see quite often, which is people buying willy-nilly, not necessarily having a long-term strategy, not getting that long-term portfolio architecture to enable them to scale. To kick us off, and before we introduce our guest for today, can you unpack why this is so important and some of the common mistakes that you see?
Yeah, look, you kind of hit the nail on the head. It's something we brought up before where more often than not, people just have some sort of goal, which don't know where it's been influenced by common media, misinformation, but they say something like, we want to buy a property every year, or we want 10 properties, or we want $200,000 worth of passive income. But quite a lot of the time it's arbitrary numbers that really doesn't reflect any kind of strategy. And more often than not, these people, when they start hanging on to these numbers, they actually make bad investment decisions because they say, oh, I want to buy a property every year. Well, in year two, let's say they didn't have enough equity to buy a good property for that portfolio. Maybe they needed to lean more into a cash flowing asset, which can be more expensive. They would just go buy an asset anyway. So really kind of unpicking about understanding your point of time, as in what you're doing in that time, your portfolio, and what the best option is based on that information, rather than just, kind of going at a whim and saying, oh, I just want to buy properties, or I just want X amount of income.
I think the world that we're in terms of property investing at the moment, especially in the resi space, has changed so much since really COVID. I think is a huge turning point, but even more recently, 2022, 2023, where you saw those like 15, 20% year-on-year gains in markets like Perth and Brisbane. And one thing that I reflect on quite often is that if you're starting your property investing journey now, it's quite hard to get those early wins than, if you went into Ipswich and Logan in 2019 and you're buying these really good established homes for sub 200,000, and now they could be valued upwards of 800,000. The wins aren't as easy, and it doesn't mean that you're going to pick a suburb off a dartboard and it's necessarily going to grow 15, 20% year on year. So to your point, you have to make these strategic decisions. You have to really be calculated if you want to grow your portfolio. Just before we introduce our guests, we have mentioned a few different areas which I think would be worthwhile unpacking a little bit more. Buying for capital growth versus buying for yield versus buying commercial real estate. Can you give us a quick insight into these three?
Yeah, look, first point is, you kind of spoke about around that COVID time a couple of years ago, but it's all relative, right? The market is always performing as it's going to perform. And you can say, oh, you could have bought into these Queensland areas, but there's as many opportunities in other markets right now. It's all cylindrical, right? One market's slowed down, another market's picking up. It's a constant cycle of gentrification, infrastructure. So there's always opportunity in the market. The difference is now is we have these interest rates which impact borrowing power, and it gets harder to, loan money. The initial getting into the market can be harder. That's one thing that I would say is, salaries haven't gone up as much relatively as properties has. So you need more cash now on hand to get into that initial property. But once you're kind of in the market, it does get a lot easier. Talking about the different assets that we've mentioned there. And so we've talked, there's, the two residential, which is buying residential for capital growth and buy residential for cash flow. I say that quote unquote because most residential property isn't going to cash flow, right? But that doesn't mean you don't target residential properties in areas with maybe a higher yield, but isn't as expected to have as much capital growth. And you do this to balance a portfolio, particularly when you're in your wealth accumulation phase before moving into commercial property. And the reason being is very obvious. You don't want to hit either an equity wall or a serviceability wall, and you still need to keep that portfolio growing to allow you the access to when you get to commercial buying or, wanting that cash flow, that you can sell off those properties or make these choices.
And some of our recent buys, my goodness, those yields are low, but you have to do it at different times in your portfolio. But today, our guest, Grant Bingham, has done this very successfully. Grant, welcome to the podcast. How are you going?
Oh, good. Nice to chat to you guys.
Now, you've done this very successfully looking through your portfolio at the moment. You did the residential buys first, had some great capital uplift there, then moved into the commercial real estate, working with Rethink on that. Can you unpack when your investing journey began and kind of what was happening in your life at the time?
Yeah, sure. So didn't set out to become an investor, incidentally. I mean, I live in the eastern suburbs. We owned a home, ended up getting priced out of the market for what we wanted to purchase. A friend of mine introduced me to Scott, and I had a meeting and started in my residential. My wife and I started in our residential investment journey. And after 3 years, made the jump to commercial. Now own a couple of commercial assets that are doing very well. But all in all, had quite a good journey to date so far.
I'll hand over to James in a second to go through some of the minutiae of your portfolio and how it's evolved over those recent years. But to start us off, what were some of your early purchases? What was your first property? How did you prioritize it, and how did you go about funding it?
Well, look, we were actually ready to pull the trigger on a principal place of residence in the eastern suburbs, and got priced out of it. And so we had a deposit ready to go for a home. So after my conversation with Scott, I very quickly bought a Queensland-based duplex with a longer-term view of potentially splitting the titles. And because we'd bought that for just over $400,000 back then in 2020, we very soon after that bought another one. So literally 4 or 5 months later, we got number two, and then we sat on those two for 12 months. Because of where we'd bought and the growth that we saw in that area, we only had to wait a further 12 months to be able to release some equity and to be able to go again. So, I was very lucky with my timing, but also, lucky to be introduced to the team at Rethink to pick out the areas that were going to best perform for me.
These were fantastic timings. Hey, James.
It's pretty good timings. And, grant raises kind of the question, the point is, everybody talks about rent vesting now as if it's a new thing, but with essentially what Grant did back there is he was already in a place that you owned and lived in at the same time.
We did, yeah.
Yeah, and then so you were looking to upgrade. That property sounds like, may not have performed the best, the one that you were living in, to give you the equity to scale up into the next property. So you've had to make a choice there, either keep on living in something which is suboptimal for the time, or look outside of that initial thought of I need to own where I live right now and going and renting. So look, you kind of mentioned it briefly, but Talk us through how you actually landed on that.
Well, look, as I say, we own the home, and I was, my heart has always been kind of in doing renovations. We did one in the UK when we lived there, and I always, wanted to do that again. So that the home that we owned that's what our plan was, and unfortunately, the cost of that renovation wasn't something that we were willing to spend on. So we tried to, we thought we'd spend that money on buying simply a better house, and that the market changed at the time. So what we suddenly, 6 months, 8 months earlier would have been able to afford was just no longer realistic. So that was where the conversation I then had with a friend who was like, essentially talked me through the process of investing, what the benefits were. And, I kind of had that light bulb moment where I thought, you know what, I've been brought up with this generation of you have to own your home and that's what you work towards. And I'd never considered investing. And after, a couple of hours of conversation with him, it just made so much sense. So, speaking to an expert about, why you target certain areas, the benefits of it, it was all fairly straightforward. So we targeted somewhere, you mentioned it earlier, Ipswich. Our first purchase was in Ipswich, which, has subsequently gone through a huge growth period, sorry. And so it was very easy to quickly move through the process of going from 1 to 3 properties. We have one in Raceview, which has also grown, essentially at the same rate. So been very, very fortunate, both with timings, but also the targeting specific areas, but also diversifying the property types. We have a duplex, we have a 2-bedroom, and we have a 3-bedroom, and all slightly targeting slightly different potential renters.
I want to just bring you back because you said your friend ran you through it and you had this light bulb moment. What was that light bulb moment? Like, what was it about what your friend told you about when it comes to investing where you're like, oh, actually, this makes sense? What was that exact piece of advice?
Well, it was more removing the pressure of having to pay your own mortgage, I guess, in a nutshell, and very much talking me through and helping me to understand the benefits of getting someone else to pay off your house, removing some of the risks that being a homeowner comes with, some of the responsibilities, again, bringing it back to the eastern suburbs. Affordability is a challenge that everyone knows at the moment. And, 5 years ago, nearly 6 years ago, it wasn't as bad as it was. So even then it was challenging. So understanding that if I purchased one, then another, in 10, 15 years time, I would have due to capital growth or through capital growth, would have an asset base that would double or triple in value. And that was really what was the moment when I suddenly went, okay, brilliant. And if I'm splitting my risk by doing a number of different assets rather than a simple PPOR, the likelihood is that I'm gonna have a greater base to play with further down the line in terms of capital growth that I can then put towards a principal place of residence, which is has always been part of the plan.
That's a really good point, right, that you've mentioned there is you can afford what you essentially wanted to live in at the time. You've gone the investor route, but now the idea is that you're eventually going to go back and maybe buy that PPOR that you do want to live in the East by pretty much leveraging markets that are performing well. That, as you quite rightly said, you could have bought one asset. It may have performed very well, maybe not. But if you're diversifying across 3-4 different properties, 3-4 different opportunities there for it to perform well and eventually draw down that equity and move you back towards where you essentially started, which is with that PPR. So it's full circle, which I always find quite interesting. Obviously decided to go down the investment route. You've sold your primary place of residence. You've brought your first investment. How long was it then until you actually moved on to your second? What did it look like? What was the trigger?
Well, look, as I mentioned previously, we were ready to buy a home in Sydney. So we had a sizable deposit ready to go. Essentially only used half of that on the first purchase. And so we're able to purchase a second one, 3-4 months later. We bought a duplex in Ipswich, and then we bought a 2-bed house in Narangba. So similar kind of pricing. I think the Ipswich property was 440. The Narangba one was 400. So again, we just wanted to slightly diversify, slightly different area. But my wife and I had always wanted to buy in Queensland, because obviously with the Olympics coming in 2032, that was going to be and continues to be a growth area. And so that was really where Scott and my wife and I kind of decided on the strategy around the purchases, or those purchases.
Okay, so you basically secured both those properties within a year. I'm going to come back to the Queensland, Olympic thing in a minute. I want to talk more about the portfolio growth, because there's some interesting points around that. So you've sat on those properties, you've got them within a year. Now just kind of run me through at what point. I'm trying to understand, what led to the decisions around when was the best time for you to, execute that next purchase or go to commercial. How did that conversation unfold, or what was the thought pattern there?
Well, it's interesting because you've referenced the arbitrary numbers that get thrown around, which is 10 in 10 or 200,000 passive income. I mean, I don't know where I got it from, but the 10 in 10 was a number I had in my head, and I think that goes back to the conversation I had with my friend originally. He was just release equity, go again, release equity, go again. I mean, that was before he or I understood, serviceability ceilings, and it hadn't come into play at that stage. But I was working very close with my broker Nathan at Rethink Financing, and we checked in, and he was like, "Look, you've got, based on the numbers I've got, you've got some equity to release. You're more than capable of doing that and going again." And that's what you said. He said you'd advised me originally that's what you wanted to do. Are you still keen to do that? And I said yes. And he was like, "Okay, I'll start speaking to the lenders and have a conversation with Scott and let's go again." So it was a fairly easy decision, and certainly kind of part of an initial plan, albeit misguided or unrealistic or unachievable. I don't know back then, but yeah, we quickly went with the third, and it was again a fairly straightforward process and an easy decision to make.
But so when you're making these decisions, right, one thing that you pointed out unknowingly there is, okay, you had the equity and therefore you still had the serviceability at this point, right? Mm-hmm. Because this is what people, as I said, miss out, is they're so fixated on one outcome or one goal of buying those properties or getting that income, that they almost kind of become removed from, what the actual portfolio is doing. They just want to buy a property. Whereas to kind of really grow a portfolio and understand strategy, it's not so much about sitting there and saying, this is what I'm going to do every single year, because there's no crystal balls, right? We don't know what's going to happen in our life. And I think your story is a really good example of this, is where you have a plan and the plan hasn't necessarily failed. It's just had to pivot due to, economy, due to lifestyle, due to maybe even changing wants. And when we were talking before, you said 10 in 10 or $200,000 passive income, but now you've actually got, 3 residential properties and a commercial underneath you. Do you still think that you actually need 10 residential properties to actually build a sizable portfolio?
No, absolutely not. And based on my experiences now as being a residential landlord, the last thing I would want is 10 residential properties to manage. You guys have talked about on previous podcasts how, they can become quite a challenge to manage. And 5-6 years in, I'm beginning, I'm literally just reading 2 emails from my property manager there going, you need to fix this, you need to fix that. So it gets to a point where, the transition to commercial makes sense. I was fortunate that it was always, my 10 in 10 was going to be a mixture of residential and commercial. But yeah, I mean, my life situation changed. You know, the industry I was working with was going through some challenges, some consolidation. So, you know, serviceability, my earnings changed. So we had to reevaluate where we were in terms of going again. But, you know, the fourth purchase, the first commercial, was always kind of where we were going to go, you know, based on that ability to earn an income, you know, cash, a monthly income from your commercial portfolio was where we wanted to get to. And, you know, whether we would leverage our residential to buy a principal place of residence further down the line, or we would sell those to pay off or pay down all the commercial loans so we have a greater income from that. So, you know, we're still going through that process with Pat at Rethink Wealth at the moment, to exactly understand what financially is the best thing for us. We have to obviously consider capital gains tax and current earnings. My wife earns quite a high salary. So, you know, all these things play into decisions that we're going to make moving forward. There's no firm decision. You know, and that's why we continue to take advice from the team that we pulled in, you know, on a regular basis, because things change all the time.
Very good, very good. And I suppose the last point that I kind of want to talk about is back away from just the pure investment standpoint of view. And it's again something that you mentioned before, where would you say that growing this portfolio has now kind of softened? You said that you live in somewhere pretty nice now in the east. Has that softened the blow to pay, for example, that rent?
Yeah, absolutely. It does. I mean, we've got an income from our commercial assets that, if we need to use for whatever reason, we can. I mean, we typically don't need to. You know, as anyone who lives in Sydney and the eastern suburbs knows, it's obviously not a cheap area, but that is a decision that we made. And, you know, our income at the moment allows for us to live there. It is affordable for us. So yeah, no, we will continue, you know, as is for the short-term future. You know, we'll continue to live where we live, and, you know, we will review, you know, as we go on an annual basis, you know, whether it be checking in with Pat or speaking to Scott or, you know, my broker Nathan. You know, we make a decision and we review it on a 6 and 12-month basis to see exactly where we are.
Perfect. Look, it's the prime example of letting the portfolio quietly support your lifestyle, rather than, you know, forcing a mediocre purchase just for the sake of ego and having a PPOR, right?
So we scaled up to those first three properties pretty quickly. Grant, I can imagine that at that point, serviceability might have become a little bit of a challenge. When did that start influencing decisions, and what was the outcome of that?
Well, serviceability was an issue, and I hate to admit it, but I heard somewhere the other day that every investor makes at least one bad financial decision as part of their journey. And my bad financial decision was, dare I say it, ignoring Scott O'Neill when he said I should have started immediately in commercial. I wasn't ready. We were both green, my wife and I, in terms of investors. So we wanted to kind of gain our experience through the residential investment route first. But, you know, we'd kind of set a timeline of, you know, let's see after 3 years where we are, between 3 and 4 years. But just as we spoke to the banks, yeah, I mean, serviceability was going to be an issue. So we did come into some money, but we released some equity from our assets, and that was the time that we chose, that we thought was right to move into commercial. We were experienced enough in the residential space, and, you know, I'd understood and spoken to the team at Rethink enough to feel confident that, you know, I was happy to move into the commercial space.
So underpinning this, you used the residential properties to build your equity. You then moved into the commercial space to strengthen your income, and then you were able to stabilize the portfolio through that. What was your first commercial buy, and how did you achieve it?
So we purchased an industrial unit / office, or an office with an industrial unit attached to it, up in Queensland. I think the purchase price was somewhere around 600,000. And that was done purely from releasing some equity. We put a 30% deposit down, so we released some equity from the residential portfolio, and we had some cash reserves that had been built up over a couple of years. So it was a fairly straightforward process. I mean, it was obviously cash flow. I say obviously, it was cash flow positive from day one. So it was very interesting to see, or very enlightening to see, the difference between capital growth and not seeing an income, or negatively geared versus positively geared, and actually seeing, a revenue come in from an asset on a monthly basis. So that was what really, was exciting. Obviously, we'd done our research and was aware of the commercial market. So, very quickly after that, the decision was, we will continue this journey and we will look to get another commercial asset as quickly as we can.
Did you find that you were nervous moving into the world of commercial property from what you knew in Resi?
No, I wasn't actually. I mean, I was confident enough in our experiences that we'd had to date in residential. This was, a couple of years, I think 2-3 years after the Inside Commercial Property podcast had started. So I'd listened to Phil and Scott talk in a lot of depth about the commercial market, and obviously dealing with Scott on a regular basis as my kind of buyer's advocate at Rethink was, he's very good at educating. So I always felt quite confident in the future that I would go to commercial and would trust those guys to help me do it. And yeah, I've been very fortunate again with what I've managed to purchase and achieve since then.
James and I are going to take in a few minutes go and unpack your moves and how you've been able to grow your portfolio. But just to wrap us off, did any of your purchases underperform throughout your journey? What would you have done differently?
Good question. It's not been without some challenges. My second commercial purchase was purchased negatively geared, but there was a specific reason for that, and it was part of the plan. There was a further commercial asset that I was going to purchase, which subsequently fell through. So my financing was on hold for a period, but now that's all back into positively geared, and it is back on track and exactly where we kind of aim it to be. So yeah, looking forward to continuing to pay down those loans and increase that income in the coming years.
It's a few more things with Grant, and look, so it's the age-old story of what a lot of clients do is they start in residential, they can't afford where they live, they use it then to build up their wealth to then have options, whether that's commercial or PPOR. And look, one thing that I want to point out that obviously is our little secret at the moment is Grant believed in the process so much that he went from client to colleague. So something's obviously worked there. Grant, how have you found that transition?
I've really enjoyed it. I mean, I joined the organisation year before last, and it's fascinating to see how all the different teams work together. I mean, as a client, looking outside in, but then coming to join and actually getting under the hood, it's been a real eye opener to see how all the different teams and divisions work collectively as a team to support our clients. So part of my role at Rethink is to talk to clients and those coming to be clients about the different divisions and how they work together. And having used the majority of our services as a client, I'm really well placed to talk to people in detail about it. So I really enjoy that. I mean, I'm currently going through the Rethink Wealth journey with Pat Casey. I use Rethink Financing and work with my broker Nathan over there. I work with Rethink Insurance and Trent and the team out of there, and Sam and the team at Rethink Property Lawyers. Are always involved when I'm getting a new property or negotiating leases. So,
and you've used residential and you've used commercial.
And I have, of course. And when I can afford it, I'll use Rethink Investing New Zealand. So yeah, look, I'm a big advocate for obviously the business and to the extent that I join the organisation, and yeah, look forward to helping other clients do the same as me.
And I suppose that's important is, when people speak to our organisation, they're not just dealing with a front end salesman who's just talking about property investing. They're dealing with people that've actually walked the journey. They're investors themselves. They've, as you've said, gone through those, tribulations and trials of the problems that people hit. So we are teaching people or buying from a point of education where we've done this, we've made the mistakes. Let us not make those mistakes for you almost.
Absolutely. And I think, look, my journey has, to date been quite successful. As I said, it's not been without a couple of hiccups, and, any investor that doesn't have a hiccup or two as part of their journey is, incredibly lucky and fortunate, but it's always part of the journey. You're always learning. The market's always changing. There's always new people to listen to. There's new information out there. So, I continue to educate myself and keep up to date with the market, but love speaking to clients and understanding their situation, because everyone is different. And when we as an organization or I have a conversation with a client, you look at them as an individual, because what is right for them is not necessarily right for the next person that we speak to. So we look at a client and their goals, and then we kind of retrofit a solution to what those goals are to help them achieve them as quickly as possible.
And I think we're on to our favorite part of the podcast, which is dissecting. Thanks so much for joining us, Grant.
No problem. Thanks,
Grant.
guys.
That was Grant Bingham. And now James and I are going to sit down and unpack the strategy that enabled Grant to grow pretty successfully into what looks like quite a strong commercial real estate portfolio. And James, you're gonna break down the sequences and the phases that he took to get there. And to start us off, I think I'm going to start right from the beginning, because this is before you and I clicked record on this podcast. We're having a bit of a chat about rent vesting, and sometimes people are all in, sometimes people aren't. Grant used rent vesting as a means through which he could get a deposit for his first investment property. Rent vesting is a little bit divisive at the moment. Some people are all in, some people are all out. What do you make of it?
Yeah, look, pulling back onto Grant's story, it's actually something I'm seeing quite a lot now, where people are calling me up. They used to have a PPOR and it's, underperformed for a couple of years, or they've realized that there isn't as many benefits maybe for them from a taxation and a cash flow standpoint of view, or even a lifestyle point of view, like Grant pointed out. It's not something that we really lean into, of that stress of, always having a mortgage. And we've all kind of lived through a life now where there's been a couple of recessions. The world is very quickly changing, and obviously people's jobs and industries are always at stake. That it probably is also a great angle to think, wow, okay, I can invest and I can have a lot more freedom and confidence to do this, right? But then if we actually look into the numbers of it, so essentially Grant went to buy a place in a premium suburb, which he couldn't afford, or at the time, I don't like to use the word can't afford, but what he wanted.
You might have been settling for something. Yeah.
What he wanted wasn't in line with his expectations. So instead he's gone, okay, well, I've actually got a pretty big deposit, big enough deposit for 2 properties in different areas. He sequenced them. He's bought one, waited a couple of months, obviously seen through that process, and then bought the second one, both in high growth markets. And then because he already had that cash flow available to support that, because if it was a PPOR, it would have cost a lot more to hold a similar asset at that price point. There's also some taxation benefits from that as well, which is going to also alleviate yearly cash flow. And then he's gone, okay, well, I can also afford to buy the third. And although Grant rightly said, at the beginning, I had this idea of 10 in 10. It's actually more of a demonstration of having an idea to build wealth, then having to pivot and go, okay, well, what is the best thing I can do right now? What is the best thing I can do for my personal situation? And I speak about this time and time again, but I really lean into, rather than creating arbitrary numbers around investing, more so understanding where you're at in your life and any potential risks or things that might come up that affect you. And what I mean by this is, as I said, we have realistically investing, whether it's property investing, shares, or many other things, it usually goes through this stage in life, which is you go through your accumulation phase. I define this when it comes to property, somebody that might be on their first property investment or their second property investment. So you have your accumulation phase, then you go on to your acceleration phase. The reason why it goes like that is once you usually get one or two properties underneath you and the market's doing the work, it gets very easy to start accessing the equity to keep on growing the portfolio.
Yeah.
So you're accelerating, right? As long as you've got the serviceability. So you've gone from the acceleration phase, you're then going into consolidation. This is the point where your portfolio is maturing and you're seeing which assets are performing, which assets are underperforming, and you're starting to look at strategic moves to either keep on at a slower rate, probably growing the portfolio, picking those cash flowing assets, those commercial assets, whatever it may be. But the idea is that you're then transitioning to cash flow. And that's where most people see the end. That's more what I'm interested in talking about. There is the fifth and final leg, which is legacy, which is, handing your properties down to any family. Personally, I'm not interested. I think, spend it all and take it with you. But coming back to Grant and those areas is Grant realized that he was kind of back into his accumulation phase. So he's accumulated as long as he could until then serviceability has become an issue. And then instead of sticking to his, I want 10 properties, he's gone, okay, well, actually now 3's actually been good enough to get me to transition into that cash flowing state, and then started looking at the commercial. And now that the commercial properties in there, we've got the opportunity to let the portfolio keep on growing. As we know, the longer he holds it, the more cash positive it becomes. And there will become a point, hopefully in the future, where Grant then may be able to dip his toe back into residential or into another commercial. And people quite often think that, you invest in residential, then commercial, and then that's like the end game. But often it's tiptoeing between the two to see where you're at and keep on going between them, grow your equity, grow your cash flow. But then in many instances, just because you're saying no to the PPOR doesn't mean no forever. You leverage the portfolio to then get back into the PPOR at a later date.
Well, because you've got the flexibility of that extra cash flow from the commercial asset. And you said something at the beginning, which I think it's pretty sage in today's real estate economy, in today's real estate environment. For a PPOR, chances are you are going to be settling for something. If you're young and you've got a kid on the way, or if you've got multiple kids, you're probably going to be settling for something where you're not going to have a backyard or you're going to be in a unit. So these are other avenues to enable you to get the cash flow to get a PPOR of your dreams. There's one thing that I do want to ask a question on, which a lot of people always get stuck on, and it's the exit strategy. There are a lot of property influencers out there that talk about buy and hold forever. To get this, you do need an exit strategy, which is exiting a property which did a fantastic job in getting the heavy lifting, doing the heavy lifting for you in building up your equity base, and bringing it into an asset which is going to have that passive income, which everyone talks about. When is the right time to sell?
This is a question I'm presented with quite often, and it actually comes back to the person again. And people are always thinking that there's a magic number or formula, but it's quite simply coming back to what I was saying is you're tiptoeing between these. I need cash flow, then I need equity, whatever that looks like. But if you're still working and, your properties are still growing and you've still got cash flow, there's no need for you to stop unless you want to, maybe you want to slow down for family or for health, or you've got your version of enough. Then that is the time, right? There's no magic number where we go, oh, you've hit, $5 million worth of unencumbered assets. Let's exit there. It really just kind of comes down to you and and what you're willing to keep on doing, and just understanding how to keep your options open with the portfolio up until you want that, right? But to kind of be more decisive, what happens is you have your portfolio, and if you are thinking about exit strategies, usually what you're going to start looking at is you're going to start looking at underperforming assets and market cycles. So underperforming assets, and you can think of this as, have a number of, we'll say residential, because that's what I specialize in. If you've held those properties for 5-6 years and they've done the heavy lifting, as you said, and the growth is slowing down, well, look, if the growth is still good but it's slowing down, that doesn't mean it's a bad asset, right? What you've got to do is you go, okay, well, if I sell that property, once I've paid my capital gains, once I've got the sales cost out of it, whatever it is there more opportunity for me to redeploy that cash? Okay. And then if I am going to redeploy that cash, how am I going to redeploy it? Am I just going to pocket it, put it in a fund and live off the money? Or am I going to push it into commercial? Or do I use that money to sell, to pay down some of the principal on some of my higher performing yielding properties? So it's really understanding your portfolio is the main takeaway, and understanding what you can do with the money, because it's not just as simple as, oh, I'll sell that asset. It's okay, well, if I sell that asset because it's underperforming, is there a way that I'm going to get a stronger performance in the market right now? Because markets, again, coming back to that first point, they go in cycles. So okay, it might have had a bad run for 2-3 years, which is usually kind of what you need to see before you can go, okay, this property's actually slowed down, but is it still doing 7% growth? And what that looks like for you.
So Scott and Phil have done a really good job on Inside Commercial Property, talking to regular Aussies about the benefits of commercial real estate. But there are a lot of people out there that might be a bit hesitant about going into commercial or seeing it as the ultimate end goal. And of course, you've highlighted there's not some magic machine that you punch the numbers in and it comes out with a definitive answer of sell X and buy Y, right? But is there a realistic pathway for people to retire just on the passive income generated from residential property? As Grant highlighted, getting emails from 10, 15 property managers every week can be pretty taxing on you. Is there a pathway for retirement through that?
Yeah, 100%. And so what we look at is there's a couple of ways you can have the passive income from your overall portfolio, but sometimes the easiest way to do is you have your ideal passive income at the given time. So let's say if I wanted $100,000 passive income, then what you can look at is what the unencumbered value of a portfolio would look like to provide you with that for that number. And they're very loose based on the economy. When it comes to having that eventual passive income, which is what most people are buying to, we actually look at is unencumbered property value. And very loose numbers, because it massively changes based on the asset type and what you've got in your portfolio. But let's say between 2 to 4 mil will give you roughly $100,000, maybe more, of passive income, right? And so, there'll be people that say, oh, what happens if I hold a load of apartments on Airbnb that are doing 12%? Yeah, well, okay, that's completely different. But generally speaking, for you to build up your portfolio where you've held a number of just standard residential assets and then deviate into commercial or whatever it is, by the time you've sold down those asset classes, whether you're holding majority commercial or majority residential, you need roughly 2 to 4 mil per $100,000 in today's money. So then what you do is you go, okay, well, me and my partner want $100,000 each passive income. You know that you need roughly $4 million, $8 million, let's just call it, of unencumbered property. And what you can do is you can then allow for inflation, everything else, to say, okay, well, in 10 years' time, that might be closer to, $350,000 worth of passive income, and how does the portfolio look there? And that's how, again, exit strategy should work is, okay, but that is the goal. So we've got to build up the portfolio of our use of that based on historical numbers. If we're going to sell down or move into an asset type, that we can achieve that.
And there's always going to be people's risk profiles that tie into this. You know, if you want to buy those 20 studio apartments or one bedroom apartments in Melbourne, you're probably going to get quite a high yield, but it's not going to be for everyone. And that's where you have the tailored, unique investing journey for each person. Now, Grant's done a pretty fantastic job to get to this level in such a short period of time. James, where can he go from here? What's his next steps? What are his next options?
Probably the best thing he can do right now is sit in at the market, do the work. Again, you know, he wanted to keep on investing, but unfortunately, sometimes that's just not possible. For one, to buyer's agent and strategist, I'm actually going to say he's actually better off just waiting now, right? So originally, he had these big dreams of all these properties, but what he's realized is he's pretty much got very close to where he wanted to be with just 3 residential assets and now 2 commercial. His portfolio pretty much washes its own face after tax at the end of the year. And now there wouldn't be really much point in him taking on any more risk, you know, going into another commercial or going into another residential investment when he's so close, maybe a year or 2 away from being able to draw out equity and actually buying that PPOR.
Thanks so much for your time, James.
Yeah, it's been a pleasure as always. Really good one. I enjoyed that. Thank you.
And look, if people do want to get in touch with yourself or the team at Rethink Residential, how can they reach you?
Best way is probably just to jump on the website and fill out one of the forms. And if you're lucky enough, the amazing Grant might actually speak to you.
Well, thank you so much for joining us today on the Inside Residential Property Podcast. My name's Liam Garman. I was joined by my amazing co-host, as always, James Thompson, where we unpacked everything that you need to know about building a residential property portfolio and those building blocks that you need to set yourself up for success in the long term, gain some equity, and in the long term, have a passive income. And if you do want to get in touch with the team at Rethink, make sure you jump on their website, but also share this with your friends and family if they're looking to jump into the property investing game. And that is all we have time for today. We'll be back at the same time next month. But until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.